How do you trade crypto with leverage in Australia? In this video, we'll break down the definition of leverage trading, explain how you can trade crypto with leverage in Australia with independent reserve, and work through some example trades to demonstrate the principle in action. Okay, let's get started. When you trade with leverage, you're borrowing money so you can place a bigger trade than what your current balance would normally allow. A leveraged crypto trade allows you to amplify the size of your position in the market. So how does this work in practice? This is Jim. Jim has $1,000 and is looking to invest in Bitcoin. Jim's crypto exchange, Independent Reserve, offers up to 5 times leverage, which means that for every dollar Jim has, Independent Reserve can lend him another $4, giving him a position of $5,000 from a $1,000 deposit. Jim expects Bitcoin's price to rise in the short term, so he opens a 5 times leveraged Bitcoin position using his $1,000 in collateral to borrow $4,000. Over the next week, the price of Bitcoin rises by 5%, bringing the $5,000 position to $5,250. At this point, Jim closes his position and repays the $4,000 for a total profit of $250, excluding fees and interest. Without leverage, Jim would have only made $50. But leverage works both ways. Imagine this time Jim's prediction didn't come true. With $1,000 of his own money and $4,000 borrowed from his exchange, Jim opens the same 5 times position on Bitcoin and waits for the price to go up. Only this time, Bitcoin falls by 5%, turning his $5,000 into $4,750. Jim closes his position, worried that the price may drop even further. After repaying the $4,000 borrowed, Jim is left with only $750, a $250 loss on top of fees and interest, or 25% of his original capital wiped out by a 5% market move. Without leverage, Jim would have only lost $50. Leverage trading can also be used to take a position on a falling price. A leveraged sell position profits if the asset price decreases and loses if the price increases. Say Jim holds $1,000 worth of Bitcoin and thinks the price is about to drop. He opens a $5,000 leveraged sell position, putting up his $1,000 as collateral while the exchange provides the remaining $4,000. That's 5 times leverage. In effect, Jim has sold $5,000 of Bitcoin at today's price and will need to buy it back later to close the position. If Bitcoin falls by 10%, the $5,000 leverage sell position costs only $4,500 to buy back. He closes the position and keeps the $500 difference, a 50% gain on his $1,000 collateral. If Bitcoin rises 10% instead, buying it back costs him $5,500. Jim loses $500, half of his collateral from a single 10% move against him. That same leverage that multiplies gains also multiplies losses. Because leverage positions are funded partly with borrowed money, you're required to keep a minimum amount of your own funds, known as margin, in your account at all times. This is usually tracked as a margin ratio, your remaining equity as a percentage of the position's value. If the market moves against your position and your margin ratio falls towards a set threshold, often around 15%, the exchange issues a margin call. This is a request to either deposit more funds or reduce your position to restore your margin. If the market keeps moving against you and your margin ratio falls below the liquidation threshold, often around 10%, the platform automatically closes your position. This is called a mandatory liquidation, and it can result in the loss of your entire collateral. Margin calls and liquidations can happen quickly, particularly in volatile markets like crypto. There's no guarantee you'll have time to respond to a margin call before liquidation occurs. It's a high-risk product that isn't suitable for everyone, and you could lose more than your initial deposit. Before you can access leverage trading on Independent Reserve, you'll need to pass a suitability test to confirm you understand how the product works and the risks involved. Learn more about leverage trading through the links in the description below.